Thank you all for being here. And the title of this event is Scaling Impact Investing, whether you say scaling impact investing or mainstreaming impact investing. The reality is that more and more people around the world are beginning to realize that so many of us that have been doing this, as Amit kindly pointed out, for more than a decade. I certainly had black hair when I started. We've been going down this journey realizing and being completely clear about the knowledge and the fact that to do good does not necessarily mean to compromise returns or to compromise other principles. And it is gratifying that we're having this event on morning one, day one, and hour one of the UN General Assembly week. And what I hope is that everybody, when they leave from here at the end of today, are going to spend time influencing their networks and spending the whole of the week forcing people not to talk about wars and pestilence and negativity, but actually the positive energy that comes out of focusing on impact investing, on focusing on the Sustainable Development Goals, on focusing how an entire stakeholder community around the world can actually make such an enormous difference in ensuring that the world that we leave to our kids, and congratulations on your new arrival, the world we leave to our kids is a better place. And thank you very much to the GIIN and to Bank of America Merrill Lynch for partnering with us to organize such an impactful day. Having the GIIN, which is the industry's leading organizer of impact investors, as well as a forward-thinking institution and actual world leader such as Bank of America Merrill Lynch, with its reach and stature as co-hosts of this platform, is in itself suggesting how much progress that we have made. My day job is actually that of a traveler. I go around the world, I meet people, and I tend to get a sense of what is happening in the investing community from Latin America across to Southeast Asia. And what I have found in the course of the last year is when we say mainstreaming impact investing, it actually is no longer something that people think is the ambit of governments or NGOs or developmental organizations. People are beginning to realize that actually there is a lot of sense in dealing with this issue head on and not compromising investment returns, but getting value for what we do. And so many political leaders are here this week, so much discussion is going to happen this week, and we hope that if this is front and center, and we see how many of the events during this week are directly correlated with the topic of this conference, then I think we have a very positive week ahead of us. The world's hardest challenges that beset us, climate change, other issues that are laid out in the SDGs, is something that we have been talking about, but look at all the new participants in this discussion. More and more politicians, more and more business people. I was in Singapore last week at the Milken conference, and I was struck by the fact that when Al Gore turned up to talk about climate change, usually he attracts 15, 20 CEOs in a room in a roundtable discussion. There were 60 people there, virtually everyone that was invited. So it is beginning to become apparent to me, at least, that more educators, more business people, more financiers are beginning to understand that this is the way forward in the future. It's great to see this. The momentum is building, and the most important element of that is let's see the scale of the impact that we can all collectively create. Where, as Amit pointed out, we're at the beginning of a rare and inflection point opportunity that is in front of us, and for us not to grasp it right now and to focus on its energy would be a criminal waste of an opportunity as well. So what is that opportunity? It's, like I said, it's a crucial moment in history. It's an opportunity to immutably and absolutely change the course of innumerable lives, to actually evolve and develop a trend in society, the planet itself, that actually begins to become much more globalized and much more embracing of everything that we have always talked about. This is the challenge that the SDGs presented us with. And 2 years ago, when they were framed and formulated, there was a little bit of cynicism around the world, saying, here they go again, it's the United Nations, the do-gooders, the people that are actually focused on doing this, and how does this apply to the rest of us? Well, in those 2 years, this wheel and this momentum has become actually extremely forward, momentum-driven and forward-looking. The investment community itself has spent a considerable time and effort on an attempt to define impact, and I'm not going to redefine it as you defined it works. To me, the definition is not as important as the actual actions that are involved in delivering it. As I'm very fond of saying, whether you are an institution like the Red Cross that deals at the micro level with individuals and human suffering, or whether you're a financial institution at the other end of the scale dealing with companies and products and moving markets, you cannot create a great company unless you start with a good company. And a good company is one that stands for what society stands for, that makes a difference in the lives of the people it employs, the families that they have supporting them, and that they're supporting the ecosystems, the communities, the stakeholders that that business is involved with. And I am convinced that as we go forward, we will come across scenarios where young people are going to walk into supermarkets or wherever they go and buy their daily needs from, and they will see 3 bottles of water on a shelf, and they will pick that bottle of water from the single company that they feel makes a difference to the community and the environment in which they're operating. And that is actually, at the most basic level, the scale of how impact can be measured. Much of the time and money that we've spent in the past as different institutions and organizations focusing on a definition of impact is good. People will continually argue over what it means. They will find ways of prioritizing certain investments over others. But we at Abraaj are completely convinced that the front and center capacity that the SDGs afford us in these 17 development goals, for us to define as responsible investment professionals, which of those 17 can we pick and how can we make a tangible difference as one financial institution in the implementation and execution of them. And you know, we've come to a point, again, with the leadership of the GIIN and Amit and people like him around the world, we've come to a point where the profile of impact investing is just continually rising. The range of tools available to the industry are increasing, and the field of blended finance has taken off as well, and this is extremely important. And there are more and more examples of risk sharing. The World Bank, under the leadership of Jim Kim, is a pioneer in driving and developing this thinking as well. And all sorts of blended structures are emerging that are bringing new capital to bear on extremely challenging issues that we all face. All of these developments are good. They're timely. It's interesting. And because our need for capital and our collective efforts are coming together, this need is so enormous. It's almost infinite. But that is part of the pleasure of doing it, because the more you involve organizations, institutions, companies that you own, people that you influence into this thinking, the sense of being able to make a difference is so powerful and so strong. So what is this opportunity? Consensus around the world seems to be, and seems to tell us, that we need somewhere in the region of $2 to $3 trillion a year to meet the requirements of the SDGs. An enormous amount of money. And when you start talking about trillions of dollars and the opportunity itself is so large, you might as well understand what I mean when I say limitless. Because if you can spend 2 to 3, if you can bring a fraction of that into this area and into this realm, then the developmental path for achieving outcomes is just fantastic. But at the same time, ladies and gentlemen, there are complicating factors that are out there that make this opportunity much, much more difficult than I am implying it to be. First of all, let's start with the plumbing of our financial system, which I am often heard saying is currently broken. There's no other way to put it. It is broken. The system of global finance that we've always depended on to finance growth is just not functioning well at all. And what I mean by that is that it is not allocating capital to places where the demands are greatest and therefore the returns are potentially highest. We have a perception of risk that is not commensurate with where risk is actually coming from. Dare I say it cheekily, that when risk came into the global financial system and into all our lives, it came from right here in New York City in 2008 with the Lehman Brothers crash. When risk is looked at from a political perspective, people turn to look at the results of elections in the West or Brexit, and that is where risk is amplified. And yet, when we have perceptions of risk, we talk about them happening in the context of emerging markets. markets that we call global growth markets, markets that you cannot avoid being involved with because 2/3 of this world's progress and this world's growth is going to come from those markets. Markets in which the average age is 26, when you compare it to the average age in OECD countries of 41. Markets where people are aspirational in terms of what they want, what they're going to get out of life, and what they've already seen on television and social media as being where they would like to go as well. So we've got to start thinking about how we redefine these risk parameters and metrics, and how we begin to understand what the allocation of capital actually means, because these old models, the dynamic allocation models that so many people rely on, are broken. What do I again mean by that? There are $9 trillion, ladies and gentlemen, that are currently sitting in negatively yielding debt instruments. Just think about that. $9 trillion. That's cash. That's money that even a fraction of which could have such a major impact across the world. $9 trillion. And what it means is that many, many, many fiduciaries around the world have decided to guarantee themselves losses for a huge amount of the capital that they're responsible for. Fantastic. Step one. I'm part of that industry, so I suppose I should take part of the credit for being so clever. However, since 2007, cross-border capital flows, and this is the sobering thought, cross-border capital flows have declined by 65%, from almost 23% of global GDP to just over 6%. And this is happening at exactly the time when we've been seeing rapid urbanization across the world. More than half of us live in cities. Mankind, it is fair to say, is now an urbanized race. Half of the growth that I was talking about earlier is going to come from 420 cities around the world, most of whose names you haven't even heard. And these cities are going to be driving global growth. So urbanization as a trend is the backdrop against which cross-border flows have slowed down. And strong growth in consumption in what we call the developing world, which is happening at the same time. And it's happening at a time when the demand and the need for clean energy solutions as a viable outcome, better healthcare services, adoption of new digital technologies has never, ever been greater. And again, I will postulate a hypothesis that I can't actually prove at this point in time, but I'll share it with you anyway, which is that I'm convinced that all the people in this room, the people in this audience, and people outside, anyone, whether you're rich or poor, whether you're American or Indonesian, about 80% of our household income is spent effectively on 4 basic commodities, which are healthcare, housing, education, and food. You can argue that maybe logistics or transportation should be a part of that, but 80% of our income is spent in these 4 categories. And the beauty of digital technology and disruption and these brave young people that are changing the manner and way in which we think, if they can bring that 80% down to 75%, forget about enormous disruption, just that 5% release of that expenditure that all of us do in daily household consumption needs is going to release an enormous amount of money, trillions of dollars, in the hands of individuals, whether they save it or they use it to consume different products and outcomes, is a sobering and an exhilarating thought of where technology could be leading us. So capital should be flowing into these opportunities in a reasonably proportionate fashion, but it isn't. And this is the breakdown in the system that I'm talking about, that I mentioned earlier, which is meant to facilitate the efficient allocation of capital. It's been happening for some time, it's just not waking up and going in that direction. So the question some people should ask themselves at this point is, okay, we know there's a big opportunity ahead of us. We know that the current system is not meeting the challenge, but how do you know that it is possible to succeed in investing for impact anyway? And so we come to the evidence, having discussed the opportunity. And organizations like us are very focused on delivering that evidence. And as the GIIN points out, and I love the concept that they point out of intentionality, okay? And the reality of how many people actually mean what they say and how many people are actually doing the things that are important to achieve the outcomes. And the evidence, I'm not going to spend too much time on it because all of you are pretty familiar with the statistics. That's part of the reason why you're in the room. But just to cover the bases, I'll say that we're at the point And we've passed the point of theorizing about whether we can achieve strong financial returns through investments that have broad societal impacts. I'd like to say that our organization is evidence of that fact. That is how we do our investments from the day that I started this firm in 2002. I'd like to say, 16 years on, after one has achieved scale, that it wasn't just about the money. The returns, the financial returns that our investors have made have been super. But the reality is that we have been from day one investing with impact. And increasingly in the last few years, we have turned to investing for impact. And study after study has revealed and discussed the fact that utilizing ESG and other SRI factors when investing in public equities actually does not compromise returns. And we've seen again and again how companies and investors have made great returns over time by aligning their strategies to meet market demands for goods and services that satisfy basic human needs as well. Philips, and you will be hearing from Frans van Houten, who is a visionary and a global leader in this space by far and away, and I'm very proud to call them a partner of Abraaj in our healthcare business. And Philips has been taking the brilliant strategy of framing its entire growth into and around alignment with the SDGs. And they're not alone. A number of other organizations around the world are doing the same thing. And in doing so, Philips, just one organization, is saying that it expects to improve the lives of 3 billion people by 2015. 3 billion people. That is just an enormous statistic, and one, again, that is extremely exciting. And importantly, what I'd like to point out is that their stock price has increased considerably since making that strategic shift towards fulfilling the SDGs. So kudos to you. And what this example has actually shown is that instead of having an anxiety about these trade-offs between financial and non-financial returns, capital allocators should realize that there is a trade-on opportunity to align high financial returns with clear societal benefits. And that's just part of the common sense. We know that companies that exhibit strong, clear, good health and safety standards with non-discriminatory hiring policies and that have good governance at the core of their business are more valuable than those that do not meet those standards. And that is, again, I would repeat, more than just common sense. For those of us that work in this world that some call developing markets, some call emerging markets, there is clear data to show that the attractiveness of this thinking and investing in places that are that people are too shy to invest into is actually enormously lucrative and accretive to returns that shareholders have. It's a question of moving from the alignment of just thinking about shareholders' short-term returns, quarterly earnings, and moving into a direction where stakeholder engagement, driven objectives, people aligned within the company on meeting those overall objectives will almost by definition lead to better returns. A fantastic statistic that I often share with people is when you look at project finance default rates, the rate in North America is 8.7%. That's 8 times higher than in Africa, where default stands at 1.1% of financings. And with a risk profile that is so much lower than North America's, and with so much less capital, notice how I said that, so much less capital being employed into Africa, it just points out to me 1.1 versus 8.5, where is the clear opportunity? It's not in the saturated markets of North America, where the likelihood of default is so high. I'm not saying take capital away. I'm just saying that that money that is sitting in negatively yielding rates is money that can actually be applied better elsewhere. We know that there is a profitable and sound business proposition around impact investing. There is great unmet demand. We know that the articulation of the SDGs by more and more businesses will lead to better and better outcomes. And the more people that build their business to address it are going to lead to sustainable businesses that will be around 10, 20, 30, 50 years from now. And again, to me, that is common sense. And again, the evidence for that is clear. And the Business and Sustainable Development Commission actually laid that out in one of their most recent reports, which is that there is $12 trillion worth of opportunities presented by the SDGs, and just 4 SDGs to start with. And that is just an amazing forward-thinking analysis, because all of the projects were identified by name, by nature, by location, and most importantly, by the returns that they can generate as well. So let's come to the last part of this discussion, which is the action that is necessary, having looked at the opportunity, having evaluated what the evidence is out there. What can we actually do? How do we take this compelling evidence and direct it into the opportunities, the sectors where the opportunity is so great? And the question that all business people ask is, okay, good, excellent, now what action do we need to take? Where do we need to go from here? And from Abraaj's perspective, the short answer is that we will continue to expand our efforts in partnering with more stakeholders, with more individuals, leverage our collective strengths, and in the interests of constantly achieving better returns. Because as a private equity firm, that's what we're in business for. But by being in business and achieving the outcomes that we achieve and generating the returns that we generate, we want to be the beacon, and we want others to join us in that collective effort in making an enormous difference to the attainment of these goals. And this is key, because it is only by thinking about partnership are we able to create solutions which are better than those which were fashioned in isolation or through selfishness. It should not be about I, me, myself, and the returns I generate to my investors. I'd like to say that we are successful investors, but where we are most successful is where we act as partners and co-join our efforts to do best with what others are doing best in. Our firm focuses exclusively on what we call the growth markets, which is a subset of what others call emerging markets. I'll just talk about them and address the issue in relation to them rather than talking about the whole world. And in many of the markets in which we operate, large-scale gains towards the SDGs will only happen if governments, if businesses, if philanthropy, if DFIs, and everybody works together to address our collective needs. And let's just use one sector as an example. Let's take energy as an example. In so many of our markets, ladies and gentlemen, governments don't have the financial wherewithal to meet the electricity needs alone of their citizens in the same way as people do in more mature markets. And one reason is that they don't have financial markets that offer cheap infrastructure with enough capacity and scale through municipal bonds, which are in turn bought by retail investors. So the capital has to come from other sources. And it doesn't mean that government is not a crucial partner in this thinking. What it means is that we need to determine the legal and the regulatory conditions that businesses operate in. We need to be a lot clearer about the framework in which that happens. And it's often there is room to improve those conditions. There is the opportunity. But DFIs like the World Bank, the Inter-American Development Bank, and others have considerable expertise in working with government and helping redefine those frameworks. They're a key partner, without a doubt. But the real reality is things happen when the private sector steps in. Things happen and change occurs and opportunity gets maximized and evolved when the private sector is involved. Of course, philanthropy will always play a key role in energy to provide new energy solutions, taking on the risk of especially innovative ideas in solving common problems. But business has the scale and the ability to take this challenge head on and make a difference. So this is what, just as one sectoral example of how partnership capital can come together, different segments of the investing space can come together. Stop using labels, start looking at what actually is working and deploy capital in that direction, whether it's in the energy sector, healthcare, elsewhere, 17 sustainable development goals, take your pick, align your organization's objectives towards meeting them, and then see what the effect of that scale can be. And the group that I have taken notice of most recently is a new set of investors, people that did not exist before, who are increasingly relevant to all of our efforts. And by that, I mean retail investors who invest through wealth management solution platforms, such as those that are offered by Bank of America, Merrill Lynch, amongst others. This increasing effort in sustainable and impact investing is an important element of helping take the efforts of organizations like us towards scale. And in part, I think that they're being driven by the emergence of millennials, young people for whom it is extremely important as to what society's values are being implemented by various organizations, what the companies that they work with or invest with stand for, and how does the individual capacity lead to a collective difference as well. And this group is seeing their role as the owners of capital in a completely different way. They're putting more and more of that capital to work with the intent of having as great an impact as possible. They've seen it in society, they've heard about it in universities, they talk about it with their friends, and this is the group that is actually going to land up changing the world as well. But on the other hand, the retiring baby boomers, who are the ones who are responsible for a lot of the savings that is getting deployed, are also crucially important, and I'm sure we will see more activity from retail investors as well. So in summary, as we go forward, our task as a private equity firm, or as I prefer to call it, as a partnership capital firm, and that of the entire asset management industry, is to provide customers with products, with investment opportunities, with strategies and solutions that satisfy financial targets, but also human targets. And I happen to believe that the private equity industry is uniquely positioned to achieve that. The best example I give is we're not a large private equity firm, but we're a very relevant private equity firm. We own 100 companies. Every one of our companies can take at least $1 million and deploy it from a philanthropic perspective, forget about anything else, into making a difference as a stakeholder in the communities in which we're operating. So if a small private equity firm can engage the companies it owns to deploy close to $100 million of capital, that can only be amplified. Imagine what the rest of the industry does, and that's just philanthropy. Imagine what happens when investment objectives through sustainable capital and through capital that is meant to change outcomes for businesses starts to get employed as well. And that is where I think that the most exciting element of collective investment schemes faces us going forward in the future. We have the ability to control our destiny. We have a disproportionate impact in achieving SDG objectives. And most important of all, we are people that the rest of the world, all of us in this room, are looking towards for that leadership as well. The Abraaj Growth Markets Health Fund, which a lot of you are participants in, investors in, or partners in, is leveraging both our expertise in growth markets, but most importantly, gaining from the partnerships of organizations like the Bill and Melinda Gates Foundation, Medtronic, Philips, the World Bank, everyone who has a collective experience in healthcare, and collectively all of us are looking to make a difference, hopefully in the lives of anywhere upwards of 200 to 300 million people in the cities in which we're operating and in the markets in which we're hoping to make a difference. So this is just a starting point. This is not an end goal. This starting point, this event, your participation, the fact that you will go away, generate new ideas and thought processes about how we can make a difference, where we can go. All I'd like to say is this opportunity is here. It is now. It is for us to take advantage of, and it is for all of us to make collectively the world a better place. As in ending, I'll leave you with the words of an 18th century English poet called Edward Young, who said that procrastination is the thief of time. And if you think about that and the profoundness with which that comment applies to each and every one of us, let's stop procrastinating, let's stop thinking about it and clapping each other on the back and talking about what a great difference we're making to actually amplify those efforts and continue to make an enormous difference, because these obstacles that we face all around the world are only going to be resolved by all of us working collectively. Thank you very much.